Why do you look so tensed?
There are so many things to see. Balance sheet, profit and loss statement, cash flow, how to invest in a stock.
Have you thought of investing in some other place other than a stock?
Stocks are the best, but how to pick them?
Have you heard of active mutual funds and passive mutual funds?
No, what are they?
Well, in this video, let's learn about active and passive mutual funds. So let's start by understanding what are passive mutual funds. Passive mutual funds are type of mutual funds where all the money is invested into an index and the fund gives you a return that is similar to the return of an index. So let us take an example here. Suppose you want to invest in Nifty 50, Bank Nifty, Nifty Financial Services, IT Nifty or any other index. You can do so by investing in a passive mutual fund. In such type of funds, the small amounts are collected by all the subscribers or the investors of the fund and they are pooled together and invested into one index. Let us now look at the different types of passive mutual funds. And let's start with an index fund. So an index fund is a type of mutual fund that invests into an index and into the stocks that represent that index. And they also provide the same return as the index. The second type of passive fund is an exchange traded fund or an ETF in short. An ETF is very similar to an index fund, but the difference is that the ETF is listed on a stock exchange, which makes it easier to buy an ETF. The third type of passive fund is a fund of fund. In these type of mutual funds, the fund manager decides to invest the investor's money in different mutual funds or ETFs depending on the investor's profile. And if you invest in fund of funds, the diversification of your portfolio is much higher than an ETF or an index fund. Now, let us look at what are active mutual funds. Active mutual funds are the type of mutual funds that actively buy and sell securities in the market. These securities can be stocks, bonds, commercial paper, treasury bills, etc. These type of funds actively try to trade in these securities to generate an alpha, which means to generate higher returns than an index. And to do this, the active mutual fund has a portfolio manager. Now, let's take an example here. Suppose you want to invest in some large cap stocks or some mid cap stocks, but you have to take time and effort to research on the best stock to pick, which is very, very difficult and time consuming. That is exactly where the active mutual funds step in. If you invest in active mutual funds, well, you get to invest in the large cap stocks or the mid cap stocks that are the best in the market right now. And also, you get the added advantage of portfolio diversification. So let us now take a look at the different types of active mutual funds. And let's start with the equity fund. So an equity fund is a type of mutual funds that actively invests in the stock market. These are very high risk funds, but they also aim to generate higher returns than the index themselves. And they also invest in special type of themes like infrastructure, consumption, large caps, mid caps, and even small caps. So they are completely linked with the market, and that is why as the market moves, the fund also behaves the same way. The next type of active mutual fund is a debt fund. Now, a debt mutual fund invests into debt securities like the name suggests. And these debt securities are bond, commercial papers, debentures, and others. And that is why these type of funds carry lower risk compared to the equity mutual funds. But because they carry lower risks, the chances of returns are also lower. The third type of active mutual fund is a money market fund. And here as well, as the name indicates, this type of fund invests in highly liquid assets or money market instruments like commercial papers or treasury bills. And automatically, because of that, the risk is very, very low. But the returns are also very, very moderate. And that is why these funds are the best kind of funds if you want to park your surplus amount of money for a short period of time. So let us take a look at the final type of active mutual fund, that is a balanced or an hybrid mutual fund. In this type of mutual fund, like the name suggests again, an investor can put their money in different kind of assets. So for example, an investor can invest 30% of the amount into equity, 40% of the amount into debt, and the remaining 30% of the amount into money market instruments. And automatically, by doing this, the investor can spread their risk and reward across all different segments and manage the fund according to their profile. So now that you have understood the difference between active and passive mutual funds, let's discuss about the advantages and disadvantages of both. And let's start with the advantages of passive mutual funds.
The first advantage of passive funds is low fees. This is because the fund manager does not need an active strategy to run the fund. All he needs to do is mimic an index. The second advantage is transparency. This means that all the details provided in the fund is the same as the underlying index. The next advantage is the simplicity of the fund, which means that investing in a passive fund doesn't need you to be a researcher, and you can just select an index and choose to invest in the index. The final advantage is zero exit load. This means that if a person wants to exit from the fund, he can do it easily without paying any extra expenses to the fund. Now, let us take a look at the disadvantages of passive funds. The first disadvantage is limited options. This means that the options of investing in passive funds are only limited as compared to the active funds. The second disadvantage is the small potential return. And this means that passive funds can give returns that are equal or lower than the index, never more than the index. Now, let us take a look at the advantages of an active fund. The first advantage is flexibility. This means that the active fund managers have the flexibility to use different strategies for investing in the market. The second advantage is hedging. This means that the active fund managers can use different strategies to hedge their portfolio to minimize their risks. And the third advantage is tax management benefits. This means that they can set off their loss-making strategies with newer profit-making strategies, which will give them a high tax saver advantage compared to passive funds. Now, let us take a look at the disadvantages of active funds. The first is the high expense ratio. The active funds have a high expense ratio which sometimes crosses 1.5%, whereas a passive fund will have a maximum of only 0.5%. The second disadvantage is the active risk. Active fund managers can make their decision to buy and sell a share in the market, which can sometimes be a biased decision, and this can sometimes create a high risk to the portfolio.
So, to conclude, we can say that both active and passive mutual funds have their advantages and disadvantages. But it really depends on the type of investor you are to select the type of fund you would require. So, if you're a type of investor that takes less risks and wants to generate the return that the index can generate, then of course passive mutual funds are the best for you. But if you're an investor who wants to take higher risk and try to generate even higher returns than the index, then active funds are the choice to go for.